Hey, welcome. We made it to another week. For people that come to our office, we have a new welcome mat. We're like literally rolling out the welcome mat.
There you go.
Big news around here. But no,
it's not red. It's not red, but it is a welcome mat, right?
Why would you, okay. Oh, the red carpet, like we're rolling off the red carpet. Okay, that took me a minute. I need more coffee this morning. But tell them why. Why did we have to add the welcome? Not have to. Why did we add the welcome mat?
Okay, tell us. You tell us.
Oh, okay. I'm going to put you on the spot. Well, because we have, we keep our door locked because of just security purposes. And so when a client walks up to our door, they have to push the doorbell. And there is sometimes a little bit of a delay until we can run out to the door and open it. But we certainly want them to feel welcome. So we want to be both safe, but we wanted our clients to feel welcome. So one of our solutions was to upgrade our front door appearance. And so we have recently added like a decal to the front door, and then we got this lovely welcome mat. We might be adding some more things.
I think it's called the feminine touch. I think you're doing really well.
Thank you. I like to just call it hospitality, but
that's right. We're better in every way, every week. So this is a good upgrade for our our door.
I love it.
Incentive for our listeners to come and visit us. Come to beautiful California, Riverside, California, right here on Magnolia Avenue. We love where we're located.
On Magnolia.
I love it. Dad, how long have you been in this building for?
40. Well, since 1982. So was that 42 years?
41?
42, yeah, 41.
Yeah, 41 going on 42. I might know because I've been born sometime around then.
Yeah, it's crazy. But I attempted to move from the building a couple times, but the location is just ideal. We have adequate parking. We're not fighting for that. We're close to the freeways. It just seems like an ideal spot.
Pretty close to downtown.
Yep,
we like it.
Enough space for our team.
Yep. And also I have certain advantages because I do the property management for the building too. So it gives me certain advantages for the company and such. So it's been really good.
There's another podcast episode. But let's not delay what the topic is today, because I think there's a lot that we can talk about here.
Yeah, for sure.
So even for people who are currently investing, this might just be a little bit of a refresher. But today's content is for anyone who is interested in investing and they kind of just want to know the basics, like 101, what are some of the things that I need to think about when either I look at my current investments or if they themselves have a greater interest in investing. So today's episode is called The Simple Guide to Investing. So let's talk about just some strategies about investing. So one of the things I want to start off with is tax-deferred versus taxable accounts. Can somebody break that down for me?
Well, yeah. I mean, for example, an IRA or a 401k, any kind of investment where you get a deduction of your earned income. So if you put in $100 a month and it reduces your earned income by $100, you get a tax deductible. So it's tax deferred. And you have to pay taxes eventually on that, but you actually get a tax break. So you have to calculate how much advantage you have. So for example, a single person who makes good income, who doesn't have any write-offs, like doesn't have a home or something like that, they're in one of the top tax brackets. IRS loves single individuals that make good money. And so putting money into a tax deductible program like a 401k and loading up, you get a tremendous amount of advantage on those initial deposits.
Right.
And the other benefit is once you get that money into those tax-deferred accounts, 401k or a 403b, some sort of, usually it's a work-sponsored account. Once you get the money in there, you don't have to worry about trades or adjusting investments over the next 20, 30 years, because every time you make a trade, that also is tax-deferred. You're not going to have to pay tax on that. So that's the qualified, we call it qualified accounts, but retirement accounts, it's a great way to kind of save for your future. The other kind is good old-fashioned investing. It's like money that you've been taxed on. You could put it in your checking account. You could put it in your savings account. It's your money. But then you take that money and you put it in usually like a brokerage account or investment account, and you start investing it. And the big difference along the way is that if you say you had Apple for a couple of years, you really liked it, it's growing, but then you kind of decide you want to invest in something else. Well, when you sell that Apple and transfer to, say, to Tesla, that Apple stock, you're going to have to pay some taxes on that. And so all along the way,
or register a loss, right? So there's going to be a transaction date, right? And they're going to look at the price that you purchased it for and the price that you sold it for. And you're either going to be at a loss or at a gain. and both will show up on your tax return.
Yeah. And the reason we talk about this with investing is just the idea that some people, when you invest, they're not even thinking about taxes. But we just want to start with taxes to say, hey, if you're in a qualified account, you don't have to think about taxes until you're retired and you take the money out. But if you're investing and it's just a regular investment account, along the way, you kind of need to think about your taxes of what the purpose is for this account, what you're trying to do with this account, and that there's going to be some potentially leakage through taxes all along the way as you make trades.
And that leakage is like somebody open up the valve, because it is a lot of money going out. So if you invest $1,000, you make $1,000. Uncle Sam is going to take about 34% of that gain. So $340 of that $1,000 gain that you made, that has a major impact upon the future value of that account. So
let's talk about some synonyms just really quickly. So a tax-deferred account can also be called a qualified account. More than likely, you're going to see these in terms of retirement accounts. So it might be an employer-sponsored plan. An easy way to identify what type of accounts that you have is to think, did I already pay taxes on the money that I put into that account? If you did, if you already pay taxes, then you're in a taxable account, which is a brokerage account or what we might call a non-qualified account. And that's a taxable account in terms of any transactions made while you hold that account. You're going to recognize short-term or long-term gain, capital gain, or loss. And those will, again, show up on your tax return. The qualified account, now all that gets to grow tax-deferred until a magical date sometime in your future, more than likely after retirement, but it might be while you're still employed. Uncle Sam will want you to start taking out money from that account, and that is when you pay taxes, and those are called required minimum distributions. So the reason why I want to bring that up in some of the synonyms is oftentimes when we first meet with a client, one of the first things that we do is account organization. They may come to us and they've had a 401k from multiple different employers in addition to their current 401k account. And what we have to do is kind of group together the qualified monies. We can't mix them with the non-qualified accounts. And that's a question that comes up a lot. Why does that have to go into my rollover IRA? And why do I have to open up a separate joint non-qualified account? So we can't mix those monies together. They have to stay separate.
That's so good. And for some clients, like when they first start working with us, that organization, that moment to get organized is so valuable, because often folks will come to us and say, I had this, I had that. I used to have some money over here and there's some in that bank, and we get it all organized and working for the client. Man, there's some clients that are well organized, but I'd say for the majority of them, they're coming in looking for us to help go through their life, tune it up, line it up, get it organized before we move forward. So that's good. So kind of the next item that I think when I think of investing is time horizon, and what the goal is. Some people will say, okay, I just want to invest. Well, our first question is like, what for? Like, we agree you should be investing, but what are you thinking about? Are you thinking about, putting a down payment on your home? Are you thinking about saving for a car, or you have to replace a roof soon? The idea of what goal you want to save for and how long you have until that goal is going to come about. Man, that's a big deal with how you need to invest it. If you have something that's you're going to need the money in 2 months. Well, in my mind, that's not something you can put in stocks, because they're going to go up and down. But if you have something you're not going to need for, say, 5 years, now we've got something we could get invested. We can get that to grow for the future.
Right. And some of the things that we hear most often are, I'm saving for my kids' college education. I'm saving for retirement. No, this money is actually earmarked. It's legacy money. It's earmarked for my kids. Short-term goals like a down payment on a home or an investment property, et cetera, et cetera.
Yeah, and the tax structures changes. Like, for example, an IRA, before they made this last legislative change to it, it could actually be inherited by a non-spouse, and the payout would be over that person's life expectancy. So if you had a child or a grandchild, it was a phenomenal legacy planning deal. A Roth account, the same thing. You got this money in there, and it goes out over the life expectancy of the beneficiary, if the beneficiary is a non-spouse beneficiary. Now, legislation changed. They looked at it and said, nope, we're not going to do that. So a non-spouse beneficiary only has 10 years in which to get it out. And so that creates a whole different ramification of how that money is going to be treated, and the taxification, the tax on that over time. So
yeah, no, it's great. So when you have your goal to say, hey, this is the goal, this is what this is the job for this money, this is what I want to use it for in the future, that helps us and any other kind of financial advisor or someone just looking at investing help determine what type of account that needs to get into and how we can invest it for the future.
And you may already have some of that money set aside, or you might be developing a strategy for how much you want to contribute. So one of the strategies we talk a lot about with our clients is dollar cost averaging. What that means is on a regular basis, it could be twice a month, every paycheck. It could be once a month. It could be once a quarter. You set the timeline, but you're regularly investing an equal amount of money. And so your overall investment exposure, that account grows at kind of an intermittent pace. And so that's one strategy. There's a lot of different strategies to investing, but what we like to talk about is good old buckets, right? Your bucket number one is your revolving expenses, right? It's going to be the bucket where you've got money that covers your reoccurring household expenses. Your next bucket is going to be your overflow kind of savings. This is your, what we also like to call your emergency fund. The car breaks down, the roof has a leak, something that's unexpected, but it's going to be a major expense. So this typically is about 3 to 6 months of your reoccurring household expenses. That's just kind of a rule of thumb, right? Your third bucket, that's where we start to talk about investing. And we want to look at, again, like they said, the goals behind that. So you might have short-term investment goals and you might have long-term investment goals. And so the strategy behind what's held in those accounts is different because the time horizon is different.
Yeah, and I think, what comes to mind is that most people, particularly younger people, they want to have a tendency to invest for the long term. And oftentimes they are not prepared for short-term expenses. Like you said, a car breaks down or there's a roof leak or whatever that is, and they're not prepared for it. So having liquidity, having that first bucket, second bucket, having some money in there, but oftentimes people are impatient. Time is, they want it now. So they want to keep investing and for the long term, but all of a sudden they get job change. They have an economic turnover as far as their business, so to speak, or there's just a sudden loss somewhere. And like, where do you get the money for that? And that's where people get into borrowing. They start borrowing using credit cards or other lines of credit, and they get themselves into trouble instead of setting up that reserve fund, which is so critical in every household, is have the money that you can dip in and get to when you need it the most. So patience is a big part of how you structure all that.
Yep. And that savings bucket, it's one of my favorite buckets because it protects all the investments. We've had a number of clients who, the season of life, they have to take a loan from their 401k, or they have to reach into their, down payment for their house goal. They have to reach into that and take it out to pay for some expenses. And that's not plan A, right? That's plan B or plan C. Those are great fallbacks and security. But really plan A is that you use that second bucket, that savings bucket, to deal with those emergencies so that your investments, your long-term investments, your retirement investments, all that can just be continuing to grow and grow. So one thing that, Laura, you mentioned, dollar cost averaging, I feel like this is probably the most accessible to a lot of people because it relates more to your paycheck, right? You finish, you run your life, you get paid, and at the end of a month, say you have a couple $100 left over. What do you do with it, right? We want our clients to have a really clear goal in mind to say, hey, I know exactly where to put this money, and I know that's going to build my future. And for most folks, say you had, you say $500 a paycheck. That's a big chunk. That's more than a car payment, right? But say you had $500 a month that you were able to take away and push into your savings. You're saying, hey, we want to be aggressive. We want to save for a home, or we want to save for retirement. If you were to do that, $500 a paycheck for 25 years, you just do it consistently, right? You don't even really think about it. You just put it in there. Well, at the end of those 25 years, assuming you get like 6% interest or growth on your account, you'd have almost $700,000. Like, that's the magic of this compound growth of, even though you put it's difficult each month, but it's not impossible, right? But over time and over growth, you come up with this massive amount of money that's useful for your future, for your retirement, for so many good things.
And I think the prime example is, Jeremiah, when you were working for the law firm, you were you're going out and buying your lunch, and all of a sudden you did a calculation of what it costs you to eat out, and you said, wait a minute, I'm not getting the enjoyment of this. So you started then bringing your lunch with you, and the savings was pretty dramatic over a 12-month period, right?
Yeah, I mean, I've told a lot of clients this story, but we saved almost $3,000 a year, and it's like, would I want a $3,000 raise just to
Right.
generally bring my lunch. And I still went out to eat when it was with a friend or for a special event. But generally on a normal day, I just brought my lunch, and
Let's
that
just
gave
talk
us
about how
a
many
raise.
points you saved in your cholesterol that year. But, I mean, that's like a side note.
Yeah,
So
right. It's
later.
good for me, and it's good for my finances.
That
But
was a double benefit.
that's right. But in being able to free up that money, that's a lot of folks. We always joke with folks, but that's the benefit of budgeting. Like, it's your money. Do whatever you want with it. Spend on it whatever you want. But the benefit of a budget is that you can identify where your money is lining up with your values and maybe where it isn't. And for me, eating out wasn't a huge value of mine, but I was able to get past that to say, hey, I'd like this as savings, and start putting that money towards things that I do value. So it is a great moment. And so
I love having that conversation with clients, because we do often have clients, especially in the initial appointments, come in. They're kind of handing over their budget with fear and trepidation. They're expecting, like, they go into their doctor's office and they're admitting how many times they eat dessert a week and how many times they're drinking alcohol. And they're expecting, shame and guilt-ridden response from the professional. And in this place, no, it's your money. You get to spend it. You get to enjoy it. But what we want to do is expose the value alignment. And if it's misaligned, then allow you to make the decisions that you want to make.
Correct. Yep.
Yeah,
we're a huge advocate for our clients' future, and that's what that is, right? It's saying, is this benefiting not just me today, but the future me, the one that I'm planning for, the one that I'm doing all the hard work for. That's so good.
So one of the terms that was brought up earlier, and we kind of want to dissect that a little bit, was liquidity. I think, Dan, you mentioned that word, liquidity. So when I think about investments and I think about money or other types of investments, I look at it from a perspective of a scale, the bottom of the scale being the most liquid or the most easily accessible to you.
So dollar in, dollar out.
Yes.
That's always use that comparison, right?
Dollar in, dollar out. That's another way to look at it. So if you guys were moving up the scale from the most liquid to the most illiquid types of investments, give me some example of those that are very liquid.
Well, just money in the bank, your checking account, savings account. Those accounts are very liquid. CDs, you would put that in that category, but you would have, if you took the money out before the maturity, they would penalize you on interest. They would take away some interest, or you'd have to reimburse the account, so to speak.
Yeah. So it's like a little slightly less liquid. And then
right.
As you move up the scale a little bit, you have, some bonds or stocks, investing in those. In order to get your money back, you got to make some trades, and then those trades got to settle. So you've got a day or two, and liquidity has to do with how quickly you can get the money. So a savings account, you get it the same day. Stocks or bonds, it's going to take you, 2 or 3 or 4 days to get the money back to your account. What I think of as you move further down is like real estate. If you wanted your money out of real estate, well, you can't just snap your fingers and get it.
Right.
You have to go to sell a home. It usually takes you 30, 60, 90 days. And so even if you need that money, you're still a couple months away from having that money usable in your account.
Right. Let's say you want to invest in an investment property. Let's say you want to invest in your cousin's latest and greatest business idea, and you are so sold on the future of this company. So you stick your money away. Guess what? That is one of the most illiquid investments you're going to get. You have to almost not consider that money as accessible to you for the foreseeable future.
Yeah, most people would put that at the very top of the investment pyramid, and the dollar amount or the percentage of your investable money should be in the smaller percent, like 5 to 10%. It should never be the all in. We're not a big believer in you just burn your bridges and put everything into it. It just doesn't make sense.
So let's go back to those buckets just real quickly. Liquidity, right? You want high liquidity, the most available, easily accessible cash to you in bucket 1 and bucket 2. Now, bucket 2 your emergency fund might have a combination of some of those CDs, right, with short-term maturity rates. It might, but we're talking about high liquidity. Once you move into bucket 3, the longer-term investing, the liquidity of those funds has to do with your time horizon. When do you need the money? Are you going to make a down payment on a home in 3 years? Well, then that's going to dictate what type of investments you hold in that account. And then on up the line. So when we're talking about long-term investments, and you tell me that the most safe and secure, the most liquid type of investment is a CD or a treasury bill, then why? Why would I even explore something like stocks or other types of alternative investments? Okay, what's out there for me? Why would I even do that?
Yeah, it's a good. We're both like, yeah, you go. I think the biggest answer is return. Like if the money is very safe in like a CD, the last 2 or 3 years they've had some really decent rates. You can get 4 or 5% from a CD. Historically, CDs will pay you 2-3% on your money. It's stable. You get you get okay returns. But you compare that to stock markets. Stock markets can pay 10%, 12%, and that's a well diversified stock. You have some of these individual stocks that they go 40, 50%, but they're very risky, and so you're constantly balancing how much risk can I reasonably take on to get a little bit better reward. And some of that is your life. Some of that is how many other, like what you're willing to take on. Some of that is your other resources. But a lot of it is that future horizon to say, hey, if I don't need this money, I have plenty of liquidity, I don't need this money for another 10 years. Wow. You're able to put that into an investment that can be a little risky because it's going to go up and down and up and down and up and down. But if you put it in, if you just say stocks for the moment, if you put it in a diversified stock account, man, I'm pretty confident 10 years from here till now, 10 years later, you're going to be pretty happy with the return over time. For 1 month or 1 week, who knows? The market moves all the time. But for 10 years, that's a great horizon for that.
Yeah, and I think that to go along with that, in the beginning stages when you're first starting out, diversification is actually key. So you want to use investment instruments in the marketplace that give you a broad diversification. So instead of trying to concentrate on individual stocks or bonds, there are funds, exchange-traded funds, and other types of investments that will give you a broad diversification and allows you now, once your account gets larger and you cross over certain thresholds like $250,000, $500,000, or such as that, then you can start investing in individual stocks because then it becomes a lot less risk-oriented. You still got your diversification, but you can put some flavor to your portfolio that you probably shouldn't try to get into when you first start out. Stay with diversified portfolio structures.
Right. And we do have some clients that like to keep what we call kind of fun money or bad money. They might have their own account that they want to explore some alternative investments, maybe some new things on the market, Bitcoin, blockchain technology, et cetera, whatever they want to invest in. Right. And that could be but what we want to deal with is the nest egg, right? We want to deal with keeping safe and secure and making sure that your risk and the return that you're seeking from the market are equally correlated. You don't want to be over risked and underperformed. So having a lower return than what you're expecting from the market. And Dad, you brought up that term diversification, which is so critical. So the more diverse your investment portfolio is, generally speaking, your risk comes down.
It does.
Yep.
It does.
And this is the old adage of don't put all your eggs in one basket. Lori just referenced the nest egg. What you have, like
we got a theme going on.
Yeah, we got some
now.
things here. But the idea is if all of your eggs, all of your assets are in one basket and that basket has a bad day, then all of your eggs have a bad day, right? Whereas if you've been able to spread out your eggs in multiple baskets and one of your baskets has a bad day, well, that's a bummer, but the rest of your eggs are still fine. And that's the same thing in diversification. Like we want a client to be exposed to 100, 200 different companies.
Yeah, I mean, you get into certain investments, you can be exposed to 500 companies for a very small investment. Yep. And it's the beauty of exchange-traded funds and some of the other investment tools. You can get that broad diversification, and the cost is very, very low.
Yeah. Right. The other benefit of this is it gets people's mindset out of the idea that I got to pick a winner, right? I got to find that stock and get that, secret information or, see that chart and I got to pick this one winner and beat everybody. Man, for like AI is a great example. You don't have to pick the AI winner, buy all of them, but buy a little bit of all the companies and let the whole industry rise up.
Buy a slice of all of them. Yeah. We have clients that come in and they're holding maybe a fantastic holding. Maybe they have PepsiCo, maybe they have Amazon, maybe they have NVIDIA that has performed fantastic over the most recent time period. Mm-hmm. However, even if they held 85, 90, 100% of their portfolio in one of those companies, we would still recommend that they diversify for a long-term security and to reduce their risk, because otherwise their retirement is all factored on whether or not Pepsi has a good day or not, or Amazon has a good day.
Well, we saw Boeing was a great one. Boeing has been a phenomenal company for so many folks who have either careers in engineering, decades. But they, with the recent plane issues, their stock tanked. It's come back some, it's gone back down. And if someone was sitting with 80, 90% of their portfolio in that one company because it had been good to them for years and years, man, they would have really felt a pinch and some pain when it came down. And basically want to insulate the portfolio from that. So diversification is great. And Randy, I love your comment that it doesn't have to be that you have to buy individual stocks for all these different companies. They call them ETFs, exchange traded funds, are these baskets. And so you just pick a basket, whether it's one basket for the entire market or one that's in tech sector one in utilities sector. You can decide what's appropriate for you.
Yeah, there's a lot of different sectors that you can get into that we can even broaden the diversification out even further, right?
Yep. So in the last 30 seconds, we're excited about this topic, lot to learn. Dad, tell us why to stay invested, because markets go up and down. Why do we stay in the game?
Well, first of all, your emotions are the worst. They're your worst enemy. So the newscast, the no matter what you read, no matter where you get your sources, if it bleeds, it leads. So they're always going to tell you the worst event, and people have a tendency to react from that. The current political environment. Oh no, if Trump gets in again, or if Kamala Harris gets elected, what's going to happen? Well, again, you have to be patient, and you have to allow time be your friend, not your enemy. So people have a tendency to pull their investments when they feel as though they're on this is going to be a really bad event. And they end up hurting themselves, not only in that period of time, but they also hurt themselves dramatically over the long term that they should be invested.
Yep. Love it. Well, we are out of time today. I hope this was helpful to some of our listeners. And thank you so much for listening.
Till next week, folks, may you grow in wisdom and knowledge. Thank you for listening.
We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about, or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricoreadvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricoreadvisors.com, or simply click on the link in the show notes.
This show is produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.